please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Pramod Gubbi is Managing Director and Head of Equities at Ambit Capital, and he's joining us from London to discuss fundamentals of the market. They're having their Ambit India Access Conference in London. Pramod, thank you very much for your time. Great to have you here. I mean, I think the basic question to begin with, which is on everyone's minds, is whether the market is vulnerable for more correction, more drawdowns broadly at an aggregate level, and will it happen quickly, or is it going to be essentially a spread out affair running through the course of this year?
No, I think there's certainly scope for more. There are significant sources of volatility that could continue through this year, making further possibilities of a further drawdown, starting with global factors in the form of continued tightening of liquidity by the Fed as the QE sort of rolls off, hitting almost a $50 billion run rate by October, and the ECB in its latest meeting has also hinted at sort of the end of QE there. So with global liquidity tightening, U.S. Treasury yields close to 3%. There is clearly a risk to emerging market assets, as we've seen in terms of outflows, that those outflows can continue, causing further weakness. And on top of it, I guess local factors as well. With while the economy is picking up clearly on the growth path, there's certain concerns emerging around inflation, current account deficit, and potentially the fiscal deficit also slipping in the election year. So given these concerns on the macroeconomic variable, there could be sort of a knock-on effect on the currency as well, which could cause further outflows from foreigners. Having said that, I think domestic inflows continue to be quite strong, which could cushion any sort of catastrophic fall to the further downside. So I guess if you ask me, possibilities of a drawdown from here are certainly real.
I mean, so when you say drawdown up to, just to put some numbers broadly, up to 5%, could be more than that, under 10%, where do you stand on that?
Yeah, I mean, I wouldn't rule out a 5 to 10%, even a 10% fall. I mean, it depends, like we've seen, because the market level at the Nifty or the Sensex level, the fall hasn't been that clear. But at the underlying mid-cap level, several individual stocks have been knocked more than 30–40%. So that is not clearly visible. So I think it's not just simply about the index, but at the broader market level, you could see further correction.
Okay. Pramod, would you agree with the assessment that, say, India is doing better vis-a-vis its other emerging markets?
Yeah, certainly. At least at the the Nifty and the Sensex level, we were clearly outperformed. But like I said, the broader market, the correction has been far steeper. Having said that, I think given the effect of liquidity and hence the effect on the currency, we relatively stand out, certainly better than some of our other emerging market peers, because most of them are open on the capital account, and the sort of hit that they take because of capital outflows is much greater than what India is. And to that extent, will continue to be seen in more favorable light on a relative basis compared to other emerging market peers.
Okay. Pramod, when do you think flows will start to come back into emerging markets, given that we're probably just at the beginning of a tightening cycle?
No, it's just the beginning of the cycle. It all depends on what call the Fed takes. There have been calls for the Fed to sort of reverse some of the roll-off program, including our own RBI governor is clearly vocally made that plea. But I'm not sure whether the Fed will take the effect of emerging markets into consideration while they'll take that decision. So if that tightening, remember we're still ramping up that roll-off and going up to 50 billion by October, and that'll be revisited sometime later this year. So at least until that point in time, I don't see these flows reversing. So all eyes on the global central banks to see if they accommodate a more less stringent view of the roll-off process.
Pramod, at Ambit, where do you see maximum opportunities for absolute gains right now across the screen, across markets?
I think the going into the election year, consumption should certainly be of interest, given this sort of spending by the government on the development program as well as general election-related spending. We'll have hopefully a normal monsoon, which should also mean rural is coming back after a tough 2-3 years. Wage growth also seems to be picking up, so consumption should definitely be one of the interesting themes. Also private sector financials, I think the sort of space that public sector banks have given away, given the lack of capitalization. Private sector banks continue to gain market share. On top of that, in a rising rate regime, some of these banks with very strong CASA can expect increasing spreads and margins, which should drive earnings growth disproportionately larger than the top line growth. So it's a double double catalyst for private sector financials in general. And also, I think if you're looking at a scenario where the currency were to continue to depreciate from here, IT should certainly be in the reckoning, not just because of the currency, but also I think there is pickup in global IT demand, and also the sort of initiatives taken by the Indian IT companies in terms of building capabilities in the new areas of big data, analytics, and so on. They should start, reflecting that in some of their, top line numbers. So between consumer, private sector financials, and IT is where we reckon most of the interest should be.
Okay, Pramod, just a quick last question then. It seems as though investors are crowding into private sector financials as well as consumption stocks, and this is despite very high valuations already. What is that a result of? Expectation of, say, growth rates being too high, or uncertainty being too high in other sectors?
I think a combination of both. Like I mentioned, because of the factors, the growth runways for some of these companies are quite long. You can see as a combination of formalization and financialization of the economy, both these two sectors can expect their high growth to sustain for much long periods of time. Having said that, if you look at on a multiples basis, you won't be able to factor the longevity of that growth. But having said that, I agree, valuations don't leave too much margin of safety. If things were to change on a structural basis, then there could be a downside on the valuation side. But given the current scenario, there is visibility of growth. But I agree, there's also the other component of the fact that there's no investment cycle, at least in a meaningful way, where other sectors of the economy can lend itself for being attractive investment ideas. So there is an element of crowding in which is pushing up those valuations.